Welcome to the Options Trading Desk. In this video, we're going to break down what a call option is and how it works in options trading. So, what exactly is a call option? A call option is a financial contract that gives the buyer the right, but not the obligation, to buy a specific stock at a certain price, known as the strike price, before a specified date, known as the expiration date. Let's look at an example. Shown on screen now are the options chains for Apple stock. The numbers down the center of the screen, followed by the letter D, show the number of days until expiration. The expiration date is also shown on the left-hand side. If we click into the 44-day till expiration option, the screen now displays the strike prices available, shown down the center of the screen. Let's assume we have a bullish assumption on Apple, and we believe the stock price will rise above $240 before the November 29th expiration date, and we decide to buy the 240 strike call. We do this by clicking on the ask price. Now that we have selected to buy the 240 strike call option, we have a summary box showing at the bottom of the screen. You can see that the limit price for this option is $4.35. All equity options are based on 100 shares of stock, so the $4.35 figure is multiplied by 100 to give our purchase cost of $435. So in summary, we have paid a premium of $4.35 per share for a call option with a $240 strike price, which expires on the 29th of November. Now, let's look at some possible scenarios for how the trade could play out. If the stock price goes above $240 before the expiration, for example, let's say the stock price was at $250 at expiration, you can exercise the call option and buy the stock at $240 even though it is trading at $250. This would produce a profit of $10 per share, but we paid a premium of $4.35 per share, leaving us with a profit of $5.65 per share. Remember, every option is based on 100 shares, so our total profit would be $565. Another scenario is the stock price finishes below the strike price of $240. In this example, we would lose the premium we paid for the option, so our maximum loss on this trade is $435. To sum it up, buying a call option is a way to potentially profit from a rising stock price with limited risk, the premium you pay. On the flip side, the seller collects the premium but takes on the risk of selling the stock if the price rises. That's the basics of a call option. If you found this helpful, make sure to subscribe for more options trading tips right here at the Options Trading Desk. If you wish to open a TastyTrade account, please use the referral link in the description. See you next time.